Very excited to be sitting with Mr. Josh Findlay from the Findlay Mortgage Team. How you doing, brother?
What's going on, man? Thanks so much for having me on.
I didn't even ask you off here. We were talking there for 45, 50, 60 seconds there. Where are you signing in from today?
I am out of the Kitchener Waterloo area.
So is that where office is as well? Like how you guys set up, mind you, now, like with COVID and stuff? Do you guys work all from home? What's kind of your logistics right now?
Yeah, head office is in Guelph, so we have a head office there in Guelph, Ontario. Uh, our agents aren't going into the office right now at the moment. We're all working remotely, so we are leveraging our video conferencing a lot. A lot of Zoom calls, but it's definitely allowed us to be able to communicate in different ways. So there's some advantages to working
Yeah,
from home
man.
as
I
well.
look, I agree with you, man. I got a team of what are we at now? 44 real estate agents, myself and my business partner, and I have 11 support staff. And so once we got into lockdown a little over a year ago, obviously, I mean, to be honest with you, Josh, I thought this thing was going to last 2 weeks. I told the crew, I go, everyone, like legit, man. I told everyone to take a 2 week vacation. I'll see you back here in 2 weeks. I was like, oh, this is perfect for me as well. I'm not a big vacationer. I mean, I do take a couple of weeks with the fam and stuff, but little did I know. But what we decided to do once we realized it was going to go longer is we set one of these Zoom conferences, Zoom meetings up, and we just let it run all day. Like we're back in it again now. We just let these Zoom meetings run all day, 8:30 to about 6 p.m. And we just work. Like there's one running right now. We call it our virtual office. And when I'm done this, and just before this, I was chit-chatting with the crew in there. And if somebody needs to take a call, they go do their call. Like in some ways, I actually found that we've been more productive. I personally am such a culture guy, though. Like I need people around. I need to brainstorm. We have a couple of whiteboards around me here. I mean,
Feel that.
they're always full, right? Like, how have you guys found? How have you kind of navigated through that all, like in terms of the culture? Because correct me if I'm wrong, and obviously my viewers and listeners want to know, like it's the Findlay Mortgage Team, and as I was looking you guys up on your site and stuff, I see a lot of Findlays, so that means it's a family run business, I take it.
Yeah, so we're kind of in a different position than you. So we're kind of like startup mode. So my business partner, like, I know Aaron, so most people associate just Aaron and myself, but we have Scott Findlay. So Scott is my uncle, also one of the owners of our company. Scott is like the wizard. Like he brought us in. He's been doing this for about 17 years. He has a ton of experience in like land development, private financing, and we were able to really enter the space, and most brokers learn that stuff later on in their career. We were like baptized in this as soon as we got in. It was like, here you go, private lending and development financing. And that's how we learned. And then we obviously figured out how to do regular mortgages. But, the culture aspect of it, it's really important because what we're doing right now is we're trying to exponentially grow. And it's working. It's about 11 of us now. We opened up our own brokerage January, so we're moving at light speed, but creating that culture, while you're so new and you really haven't had the ability to have everybody in the office, it's really it's a challenging because everybody's trying to learn, everybody's trying to create their own ways in which they're doing business. But we're trying to create that culture through technology at the moment, but I'm really looking forward to it. I'm the same way. Like I need to be around people. I need to bounce ideas off people. Like I'm moving a million miles a minute, so I need everybody else to do the same. Start working on ideas and collaborating together.
Well, congratulations. I mean, big kudos to you guys, your uncle, and the whole squad there. Like I mean, yes, we have 44 agents, 11 support staff. We've been doing this for 16 years, but we're still in startup mode. Like the amount of friggin' times I've personally hit my head against the wall, my business partner, my leadership team. I mean, it's on a consistent basis. In fact, I always say to the crew, anyways, guys, if we're not making mistakes around here, we're not doing something that's big enough, right? And so
100%.
I like what you said in terms of startup mode, because it's a good reminder for us as well that we should always kind of be in startup mode. In fact, I heard Jeff Bezos not too long ago, like literally less than a year ago, say that Amazon is still in startup mode. You know what I mean? Because it keeps the creative going and all that. In terms of mortgages, buddy, because that's what I know a lot of the listeners want to talk about. let's go kind of macro, and then we'll get into the micro a little bit. What do you guys specialize in? Is it residential mortgages? Is it commercial? Is it both? Is it refinancing? Like, where do you guys specialize?
Sure. So we're a little bit different. We don't have a specialization per se. We
Okay.
focus on helping people scale their portfolio, whether that's scaling from 1 to 4 properties, whether that's moving into multifamily, whether that's buying large multifamilies and buildings. We do all of it. So we do residential, commercial, everything in between. But we specifically specialize in helping people scale their portfolios, and by doing that, everybody has a very unique situation. And as most people have found out, the bank isn't your friend once you have 2 or 3 properties. They're your friend if you have perfect T4 income and an 800 credit score. But if you don't and you have ambitions to buy real estate, it's very difficult. So we're trying to bridge that gap.
Yeah, look, I always mention it with the bank, right? They're not a nonprofit organization. So the red bank's not going to tell you about the blue bank. The blue bank's not going to tell you about the green bank. They're not bad people. It's just that they're in it for themselves. And so if one of those other banks has a better rate or better terms, because it's not always rate, but I know people like to speak about that, but I like to look at terms in general. Look, the red one's not gonna tell you about the green one. Where independent mortgage brokers like yourselves, like, what do you have access to? I've been quoting, you're going to correct me and keep me honest right now, buddy.
Sure.
I've been quoting to people that one of the main reasons you should work with independent mortgage brokers is because they're unbiased. It doesn't matter if you get the mortgage from bank A or bank B, it's all the same to you guys. You just want to make sure that as independent mortgage brokers, investors and clients are happy, so they introduce you to more people. But one of the biggest reasons is that you have access, and this is where you need to keep me honest, that you probably have access to like over 477 lenders in the country, i.e., trust companies and credit unions, private lenders. How far off am I when I say
Oh, you're
470?
you're you're right. You're right on the head, man. So depending on where you necessarily have your brokerage, whether you work for like a Verico franchise or like a Dominion franchise, the majority of brokers work for large umbrella corporations, and those corporations allow us to have access to all the lenders. We got Scotia, First National, MCAP, all the credit unions, private lenders are a little bit more of a relationship based thing, and you're going to want to work with a broker who has those relationships with the private mortgage investment corporations and their network. But for the most part, most brokers have access to different lenders, and that allows you to really figure out what product is the best. At the end of the day, my team, I can't offer you anything better than what the bank can offer you in regards to a rate. If anything, the bank undercuts us. Now, what we can do is offer you a better experience. You can call me, I'll answer the phone. How valuable that is to have a personal relationship with somebody who's going to pick up the phone and answer a question or be responsible for your needs and your wants, and understands that you want to grow, that maybe you have 2 kids that you are putting them through college. Your goals are important, and if you're not working with somebody who doesn't know your goals or doesn't know fundamentally what you want and what the next steps are going to be, you're wasting your time. Why are you going to go for somebody who doesn't really know what they're doing?
Yeah, look, I think you guys took it back to how it used to be, like the old school days, right? In terms of banking, where you get that connection with somebody, right? Like, I used to actually work in telephone banking, and so people would call me and want to move money around, and that was awesome. But they didn't even actually have a direct line to me. It was just they would call the 1-800 number, and I was one of the guys that picked it up. But even way before that, you would go in. You'd sit down with your banker. He or she was the person who knew everything about you. Like, for scalability, I get why the bank doesn't do that anymore. But with you guys, and as an independent mortgage broker, you're doing all the homework. You're doing all the research. You're gonna figure out the best rate or terms. Yeah, the bank might be able to beat it by a few basis points, like nothing major here. Like, what do we, like? You know what I mean? And so, for the fact that you're gonna do all the research, you're gonna do all the homework, you're gonna put all the documents together, and you have the ability to shop their application to so many lenders. I mean, one person, forget 477, even if you have to go to the 5 6 major banks, like for you to take your application and go to all those, how much time is that? And your credit is going to get affected because you're going to all these places and you're
Mhm.
looking like a credit seeker, where you go sit down with someone like Josh and the crew over there, they're going to pull that credit once, and then they're going to shop for you. They're going to try to get you the best deal. So for me, I mean, it's always been a no-brainer, man. Like if I, my wallet's over there, but if I open it up, I have in my wallet all of those colors I mentioned to you. Like I have a credit card here, I have a bank card here, you have a credit card there. I have no relationship, I have no loyalty with any of the banks, because it's not like they've ever been giving me that experience. Where my mortgage brokers, I have two or three
Mhm.
that I do a lot of business with, in terms of introduce my clients to, but personally as well, because I have that relationship. So I'm so glad that you mentioned, and I appreciate the honesty, and I'm sure my viewers and listeners do as well, Josh. Like when you're talking about, yeah, they might be able to give you a better rate, but here's what we're able to offer as well. I also love, and this is what I really want you to dive into, because you said a real buzzword for me. You said build out the portfolio, right? And I think that is so important. Get that one property, great. But and I think anyone who got their mortgage license can get you that one property.
Yeah.
Like bank teller could get you that first property. But it takes someone like you guys to look at the portfolio from a 30,000-foot view to figure out, hey, Jazz, how are we going to get you your 18th property or your 82nd property, right? And so, how do you go about doing that?
Yeah. Well, very first step is figuring out goals, right? Like, what are your long-term goals and why are you doing this? And from there we can figure it out. So if you have the ability to be able to create income, like you just want to create income, and that's great. We can set up a plan for that. But if you plan on, buying a property, renovating it, pulling cash out, and buying the next one, we can plan out the most cost effective way to do that. Most people don't know that if you take a fixed mortgage, you have an IRD penalty, which is an interest rate differential penalty. It's going to cost you a fortune to break if you're in a 5-year term, and that's going to stop you right there in your tracks. So being able to plan out how you're going to source your capital for your next purchase, what your progression is. Like if you're capped on how much income you can show because you're in a salary position, maybe buying one or two or three and then looking at what maybe a fiveplex looks like, because a fiveplex in a secondary market, you don't have to qualify under your personal debt obligations anymore. That's a commercial mortgage. You start looking at assets that are self-sustaining. So, we find ways to help people in certain situations, like business owners who don't show anything on a T1 but are very cash liquid. Like, we can find ways to help people scale, and ways that in which maybe a credit union who has, a different product and services in a different way than maybe a bank would. A lot of people are going to say no, but it's the solutions and products that are offered in the market, and working with a broker who has relationships with all those different lenders is what's going to essentially be the key to it. So first question is obviously what is your goal, and like long term, how are you going to get the capital? Is there a plan to get the capital to be able to scale? And then, your qualification at the end of the day, what does that look like? And what does it look like in 5 years and 10 years?
And now, so what do you like at the time of this recording? We're right now, start of Q2 2021. Let's talk about the first quarter. If you can start to think of some of your clients, while I phrase this question for you, in this first quarter, what did you see most investors go with? Like, are they going with variable rates? Are they going fixed rates? I know you get this question all the time. Like, what as an investor should I do if I'm thinking about, because majority of my listeners, they know all we do is talk about the boring real estate, the stuff that's like watching paint dry, watching grass grow, which is buy and hold so you can refinance, pull out the equity and buy more, which I want to go through that with you and how you guys help investors do that. But what did you see most people go with, and are you forecasting a change moving forward between Q2, Q3? Variable, fixed, like what's your thoughts on that, man?
That's a great question. So, in Q1, we saw a lot of people take advantage of rock bottom fixed rates. Like it was probably the lowest fixed rate you're ever going to see. You're going to tell your grandkids one day they were giving out money for free. Like it literally unprecedented. You'll never see it again.
And it's
Um,
such a great point to that, Josh, because look, I think like when you said you're going to be telling your grandkids, here's the thing. There's also people who are listening right now and they know I don't push people to do anything. I don't convince people. I sort like if this is great for you, awesome, let's do it. And if not, that's okay. Wait for something else. They've heard me say that thousands of times, but there's going to be some people who are listening right now. And the question I like to ask them is, what did you tell your grandkids after you told them that that the banks and lenders were giving away money for free? Did you do something? Because I think your grandchildren are going to ask, like, granddad, grandma, what did you guys do afterwards? And if your answer is nothing, you might want to you need to think about that, right? Because we have never seen interest rates this low. And if the analogy is true that it's free, it's like giving away free money. What did you as an investor do? Because if the answer is nothing, I have a feeling you're going to be kicking yourself. But continue, Josh.
Completely agree. I unprecedented times. It could have went either way. Really, really, like a lot of people took advantage of the low fixed rates. Now, the majority of my clients, they took a look at obviously the variable rate as well. Variable rate was prime -1. You're still looking at the mid ones, which is unbelievable. Um, Specifically, they take it because of the 3-month interest penalty to break. It costs very little to be able to structure your loan if that's something a strategy you're looking to do. Looking into the future, obviously, the last month, fixed rates have gone up. The bond market has seen some increase in speculators, obviously, over time. So they think the economy is going to be going back, so that the bond rates are increasing, which is then causing the fixed rates to increase. We are seeing slow increases in fixed rates over time. If anybody's keeping in touch with the market at the moment, variable rate hasn't moved. So variable rate is currently stagnant. Now, I think variable rate is going to stay where it is until 2023 when the Bank of
And,
Canada
and
has
why do
come.
you think that, Josh? Sorry to cut you off, buddy. Why do you think that?
Sure. So the Bank of Canada, so variable rate is pegged off of the Bank of Canada overnight lending rate. And the Bank of Canada specifically went out and said they're not planning on increasing that rate until 2023 when they believe the economy is going to get back to, I guess, levels in which they can sustain an increase in rate. So I think you're okay with variable for now. You might want to get into an adjustable mortgage where you can take a variable rate for now. And then as you think the economy is changing or we get closer to that 2023 target, you can then flip into a fixed rate with your bank. But I think fixed rate is going to increase over time. I think when the pandemic ends, all those people who are in variable rates are going to get a little bit of a shock because rates are going to go up. The economy has to. It has to. Inflation's going to hit.
It
Rates are
can't
going
go
to
any
go up.
lower.
It can't. It can't.
Yeah. And,
It's
and and
basically free as it is.
exactly. And we would definitely not want to get into negative interest rates. I mean, if you look at what happened to the economy in
Europe.
Japan, I mean, if you want an idea of what happens when you get it's a black hole that you just can't get out of. It takes forever to get back out if you ever do. In
An
terms
interesting
of
concept.
right. If you had to put your money on something, and I'm not trying to quote you here, just kind of want to get your thoughts on it. You mentioned variable rates probably going up mid 2023, fixed rates. Do you kind like at the end of 2021? So we got another 7 months or so. Where do you see that where do you see that going? Because right now, as of today, can you still get a fixed rate for say 2% and under
Yeah,
two?
yeah.
Okay.
The insured fixed rates right now are around 2%.
Okay, and so where do you think that they might go to by the end of the year? Just to give some of my listeners some context, and they might be like literally in a purchase right now, and so at least they can we can help them through that.
I'd say probably 2.5, 3%.
Yeah, so
That's
that's
probably
not
up
that.
maybe half a point, a point.
Yeah, I mean, look, I personally don't believe that that's that big of a jump because back in 2006, I bought my first property and we paid 4.5% on a 5-year fixed. And my brothers and I, because we each bought homes in the same area, um, we thought we robbed the bank. Like we were like, holy crap, bro. Like we just got 4.5%. Why? Because we were just coming off of 6%, 6.5%. It wasn't probably, it didn't probably hit seven, but 6 to 6.5%. And so if the rates do jump up to even 2.5%, let's not forget that at one time they were 11 and 14%, but the average was always around five.
Yeah, it's an interesting concept, and I've asked myself this before. What happens if we get in a situation like that? And to be completely honest with you, I don't think our economy can sustain an interest rate hike like that. We are now stress testing at 5.25 as of June 1st, but I think you would have serious delinquencies. Most people are maxing out their GDS TDS ratios. I can't foresee the economy being able to support anything more than what we're stress testing at.
Yeah, look, and if I think if we look back at history, I think Bank of Canada and just the government in Canada here knows that the housing sector brings in so much money into the economy, right? I think the last number that came out was back in early 2020. I'm gonna have my research team just double check this and fact check me on this, but I think it was 2020 where every time someone purchased a home, approximately $87,000 was pumped into the economy. So every one purchase, that's a lot of money, right? Like you're talking about real estate commissions, you're talking about land transfer taxes, you're talking about people going to Home Depot and movers and paint, like all of that stuff. It was like around 87,000, and I'm now that I actually think about it, because I threw in real estate fees and I'm a broker, I get it. It's probably, and land transfer
Probably more.
taxes. Yeah, I
Yeah.
was about to say, when you start to actually pump into, when you start to calculate, sorry, the land transfer taxes, you probably are looking more. You mentioned June 1st. What is happening on June 1st, 2021?
Sure. So I guess the government came out the other day, and nothing has been set in stone yet, but they specifically went out and said that the new qualifying rate is now going to be 5.25. We're currently qualifying at 4.79. So that's going to change your qualification if you're pre-approved right now about like 3 or 4%. So if you're purchasing at the very max of your pre-approval, I would highly recommend speaking to your mortgage professional or banker to ensure that you can qualify for the loan that you're getting.
So walk us through that though. So somebody's going to come to you and say, Josh, I want to purchase a property. Is it different for a first time home buyer or an investor?
Nope.
Okay. So they come to you, they're going to talk to you, and then you're going to get all their information. And then when you put in that application to one of your 477 lenders, that qualification rate that underwriter is going to use is going to be at 5.25%. Even though that's not the interest rate on the mortgage, it's going to be at 5.25%. Am I correct so far?
That is correct.
Okay. So I like my personal take on this, because the last time this happened was 2018 or 19, was it? I think it was 2019, was it
It
not?
moves. It moves every now and again. So they I think they brought it down after Corona hit as well, and then it fluctuates depending on what's going on in the market.
Okay. And my take was on it. I actually didn't mind it, to be honest with you, because it's going to protect the younger generation from
I agree.
buying like stupidness, right? Like I need to buy a 3,000 square foot home because my best friend bought a 2,800 square foot home, right? Like it, like, some people call it keeping up with the Joneses. In Brampton, we call it keeping up with the Sings. Like that's just what they do there, like cousin bought 27, I gotta buy 3,000, right?
Yeah,
I'm Punjabi, so I can say that, Josh, we're good. And
yeah.
and and so I think it protects people from buying too much, where in the States, specifically back in 2008, 2009, I mean, if you could walk, talk, and chew gum at the same time, they were giving you a mortgage,
They
right?
had
And
ninja loans. No income, no job.
that's it. I mean, we all know about the ninja loans here in Canada. It doesn't work like that. I mean, Josh, you can talk to this. Like, you can have a really good salary, fantastic credit, a really good down payment, but the lender still puts you through the ringer.
Yeah,
Like,
it's tough. Like they definitely don't make buying a house easy. Especially when house prices are increasing at such an alarming rate. The floor to enter the market now is difficult. Being able to purchase a home by yourself or without the help from a parent is becoming extremely difficult to get anything above 400,000 by yourself. Um, We're seeing obviously this stress test does affect primarily the people who are looking to enter the market as an entry point, but it also, if you take a look at all the transactions that are happening, even just my book of business that I've done in the last 6 months, I'd say 60-70% are refinances. People are taking advantage of the 20% equity jump that happened this year. And I think that might have been a little bit of a band-aid fix to slow the market. I mean, I don't think it's done anything, but it's stopping people from accessing that much more equity in their property that's gone up 20% in the last 6 months, 12 months.
You said one of my favorite terms, refinancing, because I think that's something that the world of real estate investing offers that no other investment vehicle does. You can pull out equity, keep the asset, and go grow out the portfolio. I'm going to have you talk about the actual process. And if you don't mind, Josh, I mean, you and I do this for clients. We help clients do this. We do this personally. And so we have a tendency to go over this very, very quickly. And so I'm going to ask you a favor, and I want you to kind of go through it slowly in terms of how you as a broker do a refinance for someone.
Sure. Yeah, definitely. So for anybody who doesn't know what a refinance is restructuring the loan you currently have on your home to essentially pull out cash and restructure as a new first mortgage, usually. So what would happen is you'd come to a broker. We would do the same thing as the process you did with a purchase. So we take in all of your application. We take a look at your personal income, any debt that you might have. We take a look at your monthly debt obligations. So car payments, student loans, lines of credit, credit cards. All those things are valued at different amounts. So for example, if you have a car loan, your car loan is a fixed amount. So we use that fixed amount as a monthly payment. Now, if you have a line of credit, the line of credit, if it's unsecured, we're actually going to have to use 3% of the outstanding balance as a monthly payment. Now, that's the same for any unsecured piece of debt. So that could be a credit card, a line of credit. 3% of the outstanding balance is your monthly payment. If it's a home equity line of credit and it's secured, we can amortize it out and lower the payment to make it look a little bit better on an application. But we do need to take into consideration all of your debt. Now, as we were just saying, your qualification is based off of 5.25 as of June 1st. So we're going to take a look at your gross debt service, which is essentially all of the costs associated with the home. So your new mortgage payment, your property tax payment, and your heat. And now I'm going to have to take into consideration all those payments for all of your properties. And then we take a look at your total debt service, which is the second ratio we look at. The TDS takes a look at everything I just said, plus any outside debt. So your car payments, student loans, anything like that. If depending on your credit score, so if it's above 680, we're allowed to use something called relaxed ratios, which allows us to qualify 39% GDS and 44% TDS, meaning 44% of your gross annual household income can go towards all of your expenses in your house. And that's with a conventional lender. That's with an A lender. Now, we can go down the B lender path, but the alternative lender path allows you to be a little bit more creative when it comes to using rental income and ratios. You can go a little bit higher. You're not really limited to your credit score. That's how we help people scale their rental portfolios. But getting back to the refinance, we would make sure your ratios are in line, and then you can restructure your new first mortgage up to 80% of the current value of the property. We would get a new commitment, so essentially a new mortgage document. It would outline some of the conditions that would be required. We'd have to verify your income, any external information, so any mortgage that you have for other properties, property taxes, anything like that. And just make sure everything is in line with the ratios, verify the information, verify your employment, and get that new appraisal, verifying the value. And essentially, we just send it off to the lender. They verify the information, goes to the lawyer, they close the transaction.
And goes right into your checking account or savings account.
That's correct.
Tax free.
Tax free. It's borrowed money. You don't pay tax on borrowed money, guys.
And that is where also the magic is, right? For me, that legally it's the only way I can get money into my account tax free, right? And so I
100%.
love that aspect of it. Now, the other cool thing is you can take that money to Niagara or Las Vegas, put it on black or red. Nobody cares. You could do what you want. But obviously, with Jazz and Josh talking here, the two J's, I definitely think you should take that and take it over and invest into an income property. You also mentioned A and B lenders. So in the A lenders bucket, I mean, you correct me if I'm wrong, Josh. It's the six major banks, and some of the is it just the six major banks, or who else is in that A lender bucket?
No, so yeah, like credit unions offer A products as well. So they have very aggressive A products. So credit unions and regular, just essentially banks, the big six as well.
Now, when you start to scale out people's portfolio, you mentioned that B lenders is an option. What is the process there? So someone's listening right now, they got five properties, okay, and they want to, and I know, and you know out of experience, some of these A lenders don't like they don't like to finance on the sixth, seventh, and eighth. I mean, you
Mhm.
correct me if I'm wrong, like
Oh, you're
because
right.
yeah, okay. So now what is your strategy there? Is that now taking this client, this person that's listening or watching, taking them to a B lender?
So it really depends on the debt servicing. Like if you are maxing out your debt servicing, meaning we can't get any more debt to your ratios on the A side, then we do look at a B lender scenario. And one of the main advantages of using one of these lenders is how they use rental income. So for anybody who doesn't know, an A lender, like a big five bank, usually they will use 50% of the rental income on your rental, and they will then add it to your gross income to increase your gross income. And then you need to qualify for the loan. So you're taking on essentially like 50% of all the debt as well, right? So for somebody to be able to scale effectively, if you can't increase your income on paper, it's very difficult to do. Now, a B lender, this is where the magic happens. So a B lender will take 75 to 80% of the rental income on each property, and they will offset it, meaning instead of adding it to your gross income, they will use that amount and they will directly offset any liability that that property has: property taxes, mortgage payment, and heating cost. So you're essentially qualifying for 80% less of debt on each property. So you're able to stretch your income to be able to get more properties in. And one of the advantages is also they allow for higher debt servicing ratios. So they can go to about 50% TDS, which is a little bit higher than where the conventional lenders are at the moment. And some of them have some really cool debt calculators that allow you to use a rental surplus depending on how much cash flow your entire portfolio has. So you might not have a cash flowing asset, but if you have two or three that are, it might make up the difference to help you be able to use the overall cash flow to get you into the next property.
Now, in terms of commercial financing, you mentioned about the five doors and above. Um, I've heard so many clients come to me and say, Jazz, it's five doors and above. So they're not going to look at me. They're only looking at the rental income. Can we just kind of put that to bed? I mean, what exactly happens when it's five
Yeah,
doors and above in commercial financing?
that is a great question. I hear that all the time as well. I'm glad you brought that up. That's not the case, guys. So let's just put that to bed right now. You still need to be a decent buyer. You can't be a degenerate. You can't have no job. Like you need, like the bank still needs to have some faith that you have the ability to be able to make those payments. Now, the way it works for commercial financing is a lender is going to do something called a debt service coverage ratio. And that essentially looks like how much debt can this property support. So usually banks are around 1.15 to 1.25 DSCR, meaning for every dollar it costs, they want to see 15 to 25 cents is being made on that property. And that means it's a self-sustaining asset, right? So there's a handful of ways we do that. A seller, if you're going to buy a property, will give you the historical expenses. We take a look at some very specific things such as property taxes, vacancy, maintenance costs. We have certain metrics that we use. And then we just essentially take a look at the rent roll. And if that ratio is within, their parameters, they'll qualify for the loan. And then we get into the next step, personal net worth statements. What do you do for a living? Do you have capital to be able to fix something if the property breaks down? Like these 5 units, they don't have a little water heater; they have a giant boiler system. Do you have $15,000 or $20,000 in your bank account to be able to deal with that? So it's not necessarily you don't have any job, you can just go buy this, because it's probably not going to fly with lenders. But if you necessarily you don't show a lot on paper, for example, because you're a business owner, but you're liquid, or you have some savings, or you're able to get into these properties, then start looking at this as an option, because it's extremely viable to be able to scale your portfolio by buying 5 units and up. You essentially start purchasing it as a business. You purchase it in a corporation. It has cash flow. It has expenses. This is definitely the way to scale if you have some capital. Now, one of the problems is if you're buying an underperforming asset and it doesn't meet the ratios, you either need to come up with a bunch of cash to be able to get the ratios in line. So you have to be decently liquid, or you got to buy it privately, reposition the property, and then refinance into conventional lending, which, we see a lot of people taking advantage of, because the lift comes from the net operating income, right? It comes from what the tenant turnover and being able to increase the actual rent in the property, which, when people start to realize that the value of the property is associated with that, not necessarily the recent sales in the area, a light bulb usually goes off, because you can make a lot more money doing that than purchasing regular property.
100%. In terms of corporations, if one was to be buying a corporation, not necessarily 5 doors and above, let's just call it a single family home, a condo, do the qualification, does the qualification process change, like in terms of even the down payment? I've been through this a couple of times, and some lenders are okay with the 20%, but majority go down the 25% and even higher sometimes. Are you still finding that? What's going on out there if one wanted to buy under their corporation? Do they need to be prepared to put down more money, or as an investor, can they still do 20% down?
Sure. So, to be completely honest, a lot of the lenders don't allow the broker channel to be able to allow people to purchase residential real estate in a holding corporation anymore. A lot of them have just moved away from it. There are a handful of solutions available still, but a lot of them have moved away from allowing brokers to do it. Now, some banks allow direct access to it if you go into the branch and speak to them, and they, depending on who you are, they very well might increase the down payment requirement.
So
Now
you have noted. Sorry, go ahead.
they're moving away from it specifically because of sheltering qualification, right? Like it's obviously becoming a problem.
I, Josh, I'm so appreciative, my man, on how you broke down some of the basics of getting qualified for a mortgage. I mean, we spoke about everything in terms of down payment requirements, what TDSR and GDSR. I mean, a lot of my listeners who have actually even purchased before had no clue what any of this stuff meant, and they just went to the bank, or
Mm-hmm.
they maybe got lucky and they knew a broker, but that was their first property, and now they're looking for their second and their third. And as they hear and watch my content, they know the importance of refinancing. And so how you broke it down, you really did take your time through that whole process. If somebody wanted to get in touch with you, your team, what's the best place? Like what's the easiest way to get in touch with you and your team?
Well, feel free to give me a call. I mean, we can drop my phone number. I leave my personal phone on. I give it to everybody. Feel free to give me a call. I answer my phone. If I don't answer it, I'll call you back. I promise.
I
Um,
love that. Like, I like what you said earlier. There was no bullshitting. You said you can give me a call, and that's that personal touch. Make sure you, Josh, give me that number, so my team puts it in the descriptions. But is there a site, an email? What else did you want to let people know about?
yeah, check us out on Instagram. Findlay Team on Instagram. We have a YouTube channel. We drop a lot of content on YouTube. We're trying to obviously push more of that out. Trying to keep up with you, Jazz. Um, you can go to our website. We have a website. We'll leave it in the description below. Feel free to call any of us, myself or Aaron. We are always available. We're always trying to find solutions. We work 24/7, 365. As I said, we're in startup mode.
I love it. I love it, my man. I love the hunger. I could see it in your eyes. I could hear it in your voice. I really, really appreciate you dropping so many gems for my listeners and my viewers, my man. Thank you so much.
Really appreciate you having me on, man. Looking forward to the next one.